Hello and welcome to the Upside Fund Feature Edition. I'm Helen Pang. I'm here today with Ashok. Ashok is an investment analyst who covers the Fidelity Global Small Cap Opportunities Fund. Hi, Ashok.
Hi, Helen.
Please tell us a bit about what you do as an investment analyst.
Yeah, for sure, Helen. So as an investment analyst, I'm part of the broader product team here at Fidelity and act as the subject matter expert on investment strategies that I cover. That includes both Canadian and global equity funds, one of which is Fidelity Global Small Cap Opportunities Fund. I don't make investment decisions myself. That's entirely the investment management team's responsibility. But I do work closely with the investment team to understand what's happening inside the portfolio and why. So you can think of my job a little bit as helping connect the dots between the portfolio managers and the rest of the firm, whether that's the sales team, marketing, or directly with clients. And I help interpret and communicate the strategy's positioning, performance, and how the managers are navigating the current market environment.
The fund is managed by Connor Gordon and Chris Maludzinski, with 16 and 17 years of experience in industry respectively. Since inception, it has continued to outperform. As of the end of July, the fund has outperformed its benchmark MSCI All-Country World Small Cap Index by 7.9%, with an annualized return of 23.9%, outperforming 97% of its peers since its inception in September of 2022, with the institutional trust being launched in 2019. Fidelity Global Small Cap Opportunities Fund has a medium risk rating and has historically outperformed this benchmark. Connor and Chris leverage Fidelity's vast research capabilities and has a prudent security selection process.
For those of you that are not familiar with the strategy, Fidelity Global Small Cap Opportunities was launched in 2019 as a global go-anywhere best ideas portfolio to use Fidelity's global research platform to build a concentrated, high-performing fund for investors.
The strategy is based on three pillars: quality, inflection points, and concentrated risk management. We search globally for profitable, predictable, growing businesses that are undergoing an inflection point, which allows us to underwrite higher earnings, higher multiples, and ultimately, higher stock prices. When we refer to inflection points, we are referring to both thematic and idiosyncratic change. For instance, thematic inflection points refer to changes in technology, consumer behavior, government policy, and industry supply-demand dynamics. Idiosyncratic inflection points refer to changes in strategy, management, and corporate restructuring and short-term price dislocations. We package our best ideas into a relatively concentrated 60 to 80 stock portfolio designed to generate a high tracking error, alpha generative fund for investors.
Rather than looking at the overall economic environment, Connor and Chris are focused on maintaining a diversified portfolio less tied to economic or industry-specific factors, with an emphasis on analyzing and selecting stocks or companies with the best potential, and capitalizing on overlooked opportunities in the small and mid-cap space. This strategy has not only yielded substantial alpha as of July 31st, 2025, but also offered investors significant diversification benefits. Volatility is a key driver in uncovering these opportunities, as it allows the managers to evaluate mispricing and potential long-term value across the investment landscape. Recent market instability has undoubtedly worked in favor of this strategy by presenting new investment opportunities.
We think today is a particularly good time to consider adding both global and small cap exposure to your portfolios. As the market has become increasingly narrow in recent months, returns have refocused in US megacaps. This has reintroduced significant concentration risk across geography, market cap, and sector, specifically technology. We would highly suggest investors consider expanding their opportunity set and diversifying their exposure outside the current market leadership.
Small caps can be a bit of a blind spot for investors, especially global small caps. And many portfolios lean large cap by default, and even those that do include small caps tend to focus on the US, but by ignoring global small caps, investors are potentially missing a huge part of the market, nearly 30,000 listed companies around the world.
Yeah, Helen, that's right. It's a really big opportunity set and one that's often overlooked. Fidelity Global Small Cap Opportunities Fund is built to take advantage of this. It's an unconstrained bottom-up strategy that looks to uncover idiosyncratic alpha driven by stock selection and not sector or regional calls. So the managers build a concentrated portfolio from the bottom up based on a fundamental analysis. They're looking for high-quality businesses trading at attractive valuations, and they're quick to exit names when the thesis breaks down. So there's no set holding period in the fund. They'll hold on if the opportunity persists or move on if it doesn't. What really sets the team apart is how disciplined they are in rotating risk. Where markets are volatile or narrow, as they have been recently, they don't try to chase returns. Instead, they lean into their process and actively reallocate capital from more extended or headline-driven areas of the market into names improving fundamentals and more attractive risk reward. During the period of volatility that we saw earlier this year, the managers had methodically de-risked the portfolio, trimming exposure to crowded trades and moving into parts of the market that have been more neglected, but where underlying fundamentals are beginning to improve. So that includes some housing-related businesses, early cycle names in semiconductors, and even select opportunities in beaten-down sectors like healthcare.
So the Series F version of the fund has consistently ranked in the top decile since inception, reflecting its ability to deliver strong results over the long term, even across a variety of market conditions.
For sure. So that really speaks to the consistency of the manager's process. They've designed the fund to be resilient not just in terms of downside protection, but also in how they adapt to evolving market dynamics. So their focus remains firmly on long-term compounding rather than reacting to short-term noise. And while they've remained selective in this environment, they've also been finding reasons to be optimistic. Valuations across certain high-quality areas that they've been monitoring are becoming more attractive again, and dispersion could start to pick up.
So what does that mean for positioning going forward?
Right now, the managers are looking for those inflection points where the market may have overreacted to a negative shift or underappreciated a positive one. And they talked about the best opportunities often showing up in neglected corners of the market, names that are often overlooked because they're out of favor or don't fit the current narrative. Their watch list is always evolving. They're constantly reviewing valuation spreads, return profiles, and earnings resets, waiting for the right entry point. And when they see a risk-reward shift in their favor, they're ready to reallocate quickly and decisively. Even in this narrow and volatile market, the fund has maintained broad diversification across regions and sectors, and that's by design. The goal isn't to time macro trends necessarily, but to find fundamental mispricing across a very wide universe.
And what about small caps as an asset class?
Yeah, so small caps have been out of favor for quite some time, which means there's likely a lot of embedded opportunity. Historically, small caps have outperformed large caps coming out of periods of narrow leadership. And we're starting to see early signs of that sentiment may be shifting. The key here is to have that exposure in place before that turn happens, because when markets do broaden out, they tend to do so quickly, and the names that are currently underperforming can re-rate quickly as well. So that's what the managers are preparing for right now. They've trimmed where needed, taken some profits in areas that have run ahead, and repositioned into names with stronger forward-looking return potential.
Okay, thank you. And that's all for today's show. Please follow us on our socials, including Instagram, YouTube, LinkedIn, Facebook, and Reddit for more great content and the latest financial updates. You can also head to Fidelity.ca's Investor Education section to check out our articles, sign up for the Upside newsletter, get information about upcoming live webcasts and on-demand videos. Whether you're learning investment basics or looking for more advanced knowledge, we can help you become a more informed investor. As always, working with a financial advisor is among the best investments you can make. Thanks for watching, and I hope you'll join us again on the Upside.
Thanks for listening to, or watching, Fidelity Canada's The Upside podcast. Subscribe on your podcast platform of choice so you don't miss an episode. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on LinkedIn, YouTube, Instagram, or X. We'll wrap things up today with a quick disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks for tuning in. We'll see you next time.